Consider a project with the following data: an accounting break-even quantity of 15,500 units, a cash break-even quantity of 13,200 units, a 5-year project life, fixed costs of $140,000, and variable cost of $24 per unit. The required return is 16%. Ignoring the effect of taxes, find the financial break-even quantity. To find the financial break-even quantity, we're going to need both the project cost and we're going to need the project's operating cash flows. We're going to begin our analysis by calculating our break-even contribution margin per unit. Our cash break-even contribution margin per unit can be found with our contribution margin income statement. Recall, cash break-even occurs where net income is zero after we have ignored depreciation expense. This means our total contribution margin must be $140,000. We can take our $140,000 total contribution margin, divide it by our 13,200 units, and we get a contribution margin per unit of $10.61. We're going to make use of this $10.61 contribution margin per unit in our accounting break-even analysis. Let's go ahead and multiply our contribution margin per unit by our 15,500 units in our accounting break-even, which was given to us, and we find we're going to need a total contribution margin of $164,394. Recall that accounting break-even means our net income is zero. Thus, if we have a total contribution margin of $164,394 and we want to achieve net income of zero and our fixed costs are $140,000, that means our annual depreciation expense must be $24,394, simply our total contribution margin minus our fixed cost. If our depreciation expense is $24,394 per year and we have a 5-year project, our project cost is $121,970. Let's go ahead and make use of that and calculate our project's operating cash flow. Recall, we have a 5-year project life with a future value of zero. In other words, there's no salvage at the end. We'll go ahead and enter our negative $121,970, our project cost, as our present value, our 16% required rate of return for I, and 5 for a number of years. When we solve for the payment, we find our project needs to generate an operating cash flow of $37,251 a year for us to achieve financial break-even. Let's go ahead and calculate then our financial break-even in terms of units. We need to generate $37,251 in annual operating cash flows, and our operating cash flow is net income adding back depreciation expense, which was in this case $24,394. That was calculated above. Therefore, we need to generate a net income each year of $12,857. This is our operating cash flow minus our depreciation expense. In order to earn a $12,857 net income, we need to first have covered our fixed costs, which were $140,000, our depreciation expense, which was $24,394, which means our total contribution margin must be $177,251. This is our fixed costs of $140,000 plus our $24,394 in depreciation expense plus our $12,857 in required net income. Recall from above, our contribution margin per unit was $10.61. Therefore, if we need a total contribution margin of $177,251, our break-even number of units on a financial perspective is 16,712 units. This is our total contribution margin divided by our contribution margin per unit.